Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fitch Ratings Fixed Interest podcast. My name is Justin Patry. The United States is in the midst of a data center building boom driven by the growth in AI as a disruptive technology. By some accounts, almost 80% of U.S. GDP growth thus far in 2025 has been accounted for by AI-related capital investment, of which data centers is a major part. And Fitch has recently published a significant cross-sector report analyzing some of the key issues facing data centers and the related issuers' credit profiles. And I'm pleased to have with us one of the key authors of this report, Sarah Rapucci, who is a senior director at Fitch in the credit commentary and research team here in New York. Welcome, Sarah.
Thank you very much. Great to hear.
Oh, great to have you here. So, okay, so let's just start with the top. Just give us kind of the overarching views as to, why is Fitch writing this report right now? Why are data centers kind of so important?
Yes. Data centers have obviously been in the news a lot recently due to the eye-popping numbers in terms of investments that especially large technology companies are making in data centers. So when you think of the billions of dollars that Meta or Microsoft are pouring into hyperscale campuses and power and chips, I think that's been a lot in the news. Obviously, there's not just AI data centers, there's cloud computing data centers and co-location data centers, and Fitch analyzes all of these. And when we think about the cost pressure on the sector, it happens to be the case that this year's been a little bit more perhaps stressful because we see these increasing costs, but it's also compounded by an environment of inflation that's driven by some developments this year that's going to keep upward pressure on data center build out and maintenance.
Yeah, let's get into that, because I think that was one of the interesting points about this report was, you were flagging some kind of emerging challenges for data centers and specifically related to cost. So can you maybe develop that point as to what are these challenges starting to face data centers?
Yeah, exactly. So I think one of the biggest developments that we've seen this year is tariffs, obviously, and tariffs on construction inputs, namely these 50% tariffs on steel, aluminum, and copper, are contributing to higher operating and CapEx costs for both data centers and utilities. So keep in mind that electricity costs are a key cost for data centers. And these costs are going to be, to expand generation, to meet this demand, are going to be passed on to data centers in the form of higher electricity prices. So we've seen average U.S. electricity price growth outpacing headline inflation rates, and this is driven by demand that exceeds capacity as well as higher natural gas prices. What's important also to keep in mind is that utilities have traditionally relied on natural gas as well as wind and solar to increase capacity, but we've had some hiccups that we've seen this year that might make this a little bit more costly. So the phase out of technology-neutral tax credits under the 2025 tax and spending bill is going to increase renewable development costs. We also may have potential tariffs on polysilicon and wind turbines, which is going to increase costs for these key renewable components. So it might be, it's going to increase utility CapEx for sure.
Yeah, I think saying that electricity costs exceed inflation is a very mild way of putting the cost inflation there this year. Yeah. But, Fitch is a ratings agency, so obviously our principal focus is on the credit ratings perspective. So what are the kinds of issuers that Fitch thinks about or, analyzes and examines and provides ratings for related to data centers?
Yes, there's obviously a lot of players in this space. Rated issuers involve the large technology companies or large technology hardware companies that provide servers or chips. We also rate the real estate investment trust, data center infrastructure projects, and structured finance transactions such as, asset-backed securities or commercial mortgage-backed securities that are backed by data centers. The report, the cross-sector report that we wrote, mainly focuses on securitizations, REITs, and data center projects. But of course, we can't forget utilities because they're a huge consideration for the sector. Power availability and cost are critical for data centers, and investor-owned and public utilities capital expenditure is growing rapidly to address this higher demand.
Yeah, so let's talk about utilities. You mentioned a number of different issuer types there. But yeah, maybe develop the point on utilities. The report goes into that in a fair amount of depth. So how are utilities addressing this the substantial increase in demand and given existing supply?
It's a good point. Utilities are definitely investing in increasing capacity and grid improvements and new transmission lines, although these year-long timeframes for transmission infrastructure permitting and connections are actual constraints on data center expansion. Utility CapEx is already high because of grid modernization and climate resilience, as well as renewable investments in renewable generation. And we expect, again, investor-owned utility CapEx to grow by 15 to 20% year over year in 2025. And again, this is, we've seen similar growth in the public utility space. Higher wind and solar development costs, partially, again, as a result of the curtailment of tax incentives and potential tariffs, are also going to keep upward pressure on these prices.
Okay, so CapEx is obviously usually a pretty key issue for ratings, given that's usually what can drive increase in leverage. But let's go beyond utilities now, going back to some of the other issues you rated across a variety of different sectors. So what are the key things you're looking at for the sectors and issuers outside of utilities that we rate?
Yes. So when we are looking at data centers, we're focusing on leases and the ability to pass through costs. The majority of tenant leases that we see are triple net leases, where you obviously can pass through costs to tenants, or modified gross plus electric. Tenants are also typically responsible for the equipment and therefore assume some technological obsolescence risk. Stronger credit quality data centers have long-term leases that pass through costs to a highly rated tenant or multiple high credit quality tenants with staggered lease maturities. And stronger credit quality data centers are also in demand based on relative efficiency and minimal deferred maintenance.
Well, so it sounds like there's some protections for our ratings within existing ratings levels there.
Yeah, absolutely. We're trying to build in that stress level and rate to that. Yes.
Okay, so if most of our ratings are what we call stable, which means we don't expect ratings changes even despite these challenges, despite the increased capex, are there what are the kind of the scenarios or trigger points that we are looking at that could result in negative rating action for the issuers related to the sector?
Yeah, sustained cash flow would be a clear negative for the sector. And right now, rents are strong and even growing in the midst of robust demand. And so you can increase rents when you have low vacancies. However, supply-demand fundamentals may shift, and this is dependent upon AI evolution, power availability, and development of secondary data center markets. So a lot TBD. We contemplate these risks in terms of increasing costs and obsolescence when we stress cash flow durability in our analysis. And so our rating case assumptions and our cash flow forecasts incorporate stresses for things like churn and vacancies, lease renewal prices, obsolescence, and higher operating and capital expenses.
Okay, some known unknowns there.
Yes.
Well, thank you very much, Sarah. And as always, thank you very much to our listeners. If you would like to learn more about any of Fitch Ratings' credit views analysis, and including our analysis on data centers, please visit our website at fitchratings.com.
Subscribe to Fixed Interests wherever you get your podcasts.